This is a customer question. As a real case, I have about $1 million in my IRA account. There are conditions where I have to withdraw a certain amount. So it's a situation where it becomes taxable income, and the topic is about what strategies exist to reduce this and aim for efficient estate planning. It's a planning strategy for high net worth individuals and seniors who don't necessarily need to withdraw from their IRA. This is a customer question. As a real case, let's take a look here. I am a 75-year-old woman. I have about $1 million in my IRA account. I have enough other assets, so I don't need to use this money right away. However, there's the RMD, which stands for Required Minimum Distribution every year. Once you reach a certain age, starting at 73, you are required to withdraw a certain amount from this IRA account. This then becomes taxable income, and so this person is also subject to this RMD. It's inconvenient to be forced to withdraw this money. I want to pass on my IRA assets to the next generation in a way that's favorable for inheritance and reduces taxes. What options are there? That's the question. This is a concern for high net worth individuals or those with sufficient assets who don't necessarily want to withdraw from their IRA but are forced to due to the RMD. It's a common topic. Since you have to make mandatory withdrawals from an IRA, creates a tax burden, and the topic is about finding ways to reduce this and achieve efficient inheritance planning. There are two main issues here. The first is the RMD. Since the client is 75 years old, they are required to withdraw a certain amount from their IRA account every year. This means that even if they have assets elsewhere, they are forced to withdraw from this account, and they must recognize this as income and pay taxes on it, which is a concern. While it might seem like a fortunate problem to have, it's not necessarily so. There are many people who are concerned about the RMD issue. This is a concern that can affect not only those with very high assets. So the question is how to solve this problem. The question would be whether I can reduce my taxable income. Then the second issue is the issue of inheritance. This client as well, since they have many other assets, if they don't necessarily need to withdraw from their IRA assets, they wouldn't want to withdraw and pay taxes. Moreover, if they can pass it on to the next generation, they would certainly consider doing so. Therefore, the issue is how to efficiently pass it on, while simultaneously reducing the burden of inheritance and income taxes. So there are these two issues. This is an introduction to strategies for alleviating the burden of RMDs and inheritance planning. Now, before we take a look, let me mention this channel again. Our channel provides professional information on U.S. law, tax law, and financial planning in an easy-to-understand manner. We will continue to upload not only this video, but also many more beneficial contents in the future, so please make sure not to miss out. Also, to ensure you don't miss anything, if you haven't already, please make sure to hit the subscribe and like buttons. Right now, let's get started then. Here, I'm going to talk about four things. The first of which is something called a Qualified Longevity Annuity Contract. It's referred to as QLAC. The term is difficult. Please bear with me. I'll just refer to it as the 85-year annuity. What this allows you to do is purchase an 85-year annuity product with up to $200,000 from an IRA account. Then this amount is excluded from the RMD calculation. So what benefits can we gain from this? What about you? First, the RMD burden will naturally decrease. You can reduce the mandatory distribution amount that you have to withdraw and recognize as income each year. The second advantage is that since it's an annuity product, you are guaranteed a stable income cash flow after the age of 85. Ultimately, that would be the second benefit, as it becomes increasingly difficult to manage assets after the age of 85. In such cases, the advantage is securing a cash flow that you can receive without worry. Let me explain with an example. Previously, we mentioned Mr. A, who is 75 years old. He has an IRA worth $1 million. So, when asked about his RMD for someone who is 75 with $1 million, the RMD amount that must be withdrawn, and thus subject to income tax, is generally around $41,000. Naturally, the entire amount will be taxable income. However, if $200,000 of this million is used to purchase a QLAC, which is an annuity product for age 85, the RMD calculation will be based on $800,000 instead of $1 million, which means that when you calculate it this way, it drops to $32,000. In other words, from the previous $41,000, it becomes $32,000, allowing you to reduce the amount you must withdraw, and consequently reduce your taxable income. Additionally, as I mentioned earlier, by using this $200,000 to purchase an annuity product that you will receive after age 85, you will be able to receive a certain pension payment. It will probably be more than $15,000. If you purchase it at age 75 with $200,000 annually, Well, there might be some pluses and minuses, but in any case, you will be able to enjoy the additional benefit of receiving a stable cash flow of about $15,000 annually for life. Ultimately, this means that if you purchase the annuity through a QLAC from an IRA, in the short term, the RMD burden has decreased from $41,000 to $32,000. It reduces and ensures long-term income stability. Especially, as you get older and find it difficult to manage investments directly, it can be summarized as having the great advantage of ensuring a stable cash flow. Let's move on a bit faster. So, when considering what the second method to control RMD might be, there is something called a qualified charitable distribution. This is also referred to as QCD. This term is a bit difficult as well. To put it simply, it means that you don't include the RMD amount in your taxable income. Instead, you donate it directly to a charity. This means that the amount you donate to the charity can be used for your RMD. So ultimately what that means is because you are donating to a charity, it is deducted from your RMD, which in turn reduces your taxable income. Then, if you think about it, how is it different from receiving income from RMD and then separately giving it to a charity later? Because this QCD is about giving directly from the IRA account to a charity in the form of a QCD. Well, it might not be necessary to delve into this much, but since we're on the topic, let me tell you about regular donations. Although you can receive a deduction in the form of an itemized deduction, it increases your AGI, adjusted gross income, which in turn raises the burden on other taxes like Medicare tax or Social Security tax. In contrast, since QCDs are not included in AGI, they actually provide the benefit of reducing Medicare tax or Social Security tax by the amount of the QCD. Nevertheless, when choosing a charitable entity, you cannot use your private foundation. If there's a limitation, that's it. On the other hand, if I don't use a QCD and make a donation after receiving an RMD, I can use my family private foundation, so it's about my legacy. In any case, in this case, the person has sufficient assets, so they don't need this income for personal expenses. Therefore, they might have the desire to create an asset institution to continue building their family's legacy throughout their lifetime or even after. In such a case, a private foundation would be a much more effective means. From that perspective, whether you reduce RMD through QCD or establish a foundation after receiving RMD and contribute to it, both options have their pros and cons in terms of reducing taxable income. Regarding the third method to reduce RMD, similar. This also means using an annuity and utilizing it when converting the purchased annuity into a ROT. To explain this a bit more specifically from an IRA account, you purchase an annuity, so by utilizing the lower account value of the annuity, you reduce the taxable income that needs to be picked up when we convert to a Roth IRA, thereby reducing the tax amount. Once it is actually moved to the ROT, it's a strategy that allows you to enjoy greater benefits in the long term through a higher income value. After explaining it like this, I feel that it might be difficult for those watching this video to understand it right away. Well, there's nothing we can do about it. Still, to explain it as simply as possible, when we buy an annuity product, two types of values are calculated. Is called the account value. The other is called the income value. It would be good to explain with an example. For example, let's say I bought an annuity with $500,000 in IRA assets. Then, when you first purchase it, the account value decreases significantly because of setup costs, initial administration fees, and so on. This account value initially decreases significantly. For instance, let's say it becomes $450,000. However, the income value, which is calculated simultaneously in this annuity product, continues to increase. In that case, if I buy an account from a traditional IRA, the account value is set low in the initial years, but if we convert this annuity product later, the amount we need to pick up as income at the time of conversion is calculated based on the account value. So, if I actually buy an annuity from a traditional IRA and convert it later, when the account value is low, I would benefit at least in terms of the income one pickup. When the annuity product actually provides me with income in the form of a pension, it pays based on the income value, not the account value. So use the balance that was in the traditional IRA, which is $500,000, to buy an annuity. By converting to a Roth when the account value is lower, I reduce the amount of taxable income recognized. However, after moving to the Roth, the annuity benefits I receive are based on the increased income value, so I can achieve a significant effect. You may not have considered this opportunity, but for those who are concerned about RMDs and want to benefit from recognizing such RMDs and taxable income through annuity products, I hope you consider this idea and discuss it with those who assist you. Ultimately, this means minimizing the tax burden on IRA assets. In the long term, because it's an annuity, it's a powerful tool that allows you to secure a stable income. It means that you can escape the burden of RMDs and, after transferring to a Roth, obtain a stable cash flow tax-free, making it a very powerful solution. Now, lastly, the fourth one. The fourth way to solve the RMD issue is surprisingly simple. It might seem obvious, but it's converting a traditional IRA to a Roth IRA. Of course, you pay income tax at the time of conversion. Nevertheless, after that, whether it's the growing amount or the amount you withdraw, there's no RMD burden. You can continue to maintain your desired investment assets as much as you want. And also, if it is inherited after your passing, the heir can withdraw the funds tax-free. In that regard, it can also reduce the income tax burden for descendants. In that sense, it's definitely worth considering. Of course, the downside is, as you know, when you convert the entire amount to a Roth, you recognize taxable income on the entire amount. So you should choose a year when the tax rate is lower if possible. Ultimately, this means that converting to a Roth IRA may be a tax burden in the short term, but it eliminates the RMD burden. It can also be said to be a long-term planning tool that simultaneously reduces the estate tax burden. Next, this was the second issue. The concern is about what good method there are for not using and inheriting this in an IRA. Here, I will try to discuss three things. The first is what's called a stretch IRA. After the recent amendment of the Secure Act, according to the current law, it is as follows. When you inherit an IRA account that you held, if the inheritor is not a spouse, there is a regulation that the IRA must be depleted within 10 years. Additionally, a spouse has the option to convert the IRA into their own name and stretch it over their lifetime. Therefore, it would be helpful to consider who will take it and how much they will use it by appropriately utilizing these options. For example, if I have $1 million like an inheritance, if a spouse inherits a $1 million IRA and converts it into their own IRA, then the RMD would be calculated based on the spouse's life expectancy. If it's not the spouse, for example, a child, if a child inherits this $1 million IRA, they could withdraw $100,000 annually over 10 years. They will have to pay income tax on those amounts. And the second option is, it would be similar to the option of reducing the RMD mentioned earlier. It's worth considering converting to a Roth IRA before inheritance. Previously, I mentioned the advantage that although you pay income tax once, any amount that grows afterward or that you withdraw later is not subject to RMD because it's a Roth. This is also very beneficial from an inheritance perspective because if you have $1 million and you convert it to a Roth before passing it on to your children, it reduces or eliminates the income tax burden that your children would initially have to bear. Additionally, the amount on which you've paid taxes is excluded from your taxable estate for inheritance purposes. In this way, you can enjoy the benefits of reducing both the inheritance burden and the income tax burden. And finally, the third method is using life insurance. In what way? After withdrawing funds from the IRA, you do pay taxes, of course. However, if you use the remaining amount to purchase life insurance and then pass it on, you can receive exemptions from both income tax and gift/inheritance tax. That's what it means. For example, in the case I mentioned earlier, Mr. A withdrew an IRA balance equivalent to $500,000. Then you would pay whatever taxes are due. And after paying $150,000, if you have $350,000 left and invest it in life insurance, the death benefit that the children receive after passing. This means that you can receive death benefits tax-free. Of course, it would be exempt from income tax. By using a trust or effectively utilizing the lifetime exemption, you can be exempt from not only income tax but also gift and estate taxes. Therefore, life insurance can also be seen as a powerful tool to pass on an IRA tax-free. Conclusion. I have discussed several strategies to achieve two goals: reducing the burden of RMDs and finding the most effective way to pass on an IRA. The first was the QLAC, an annuity product for age 85. The second was the method of charitable giving through QCD. And the third was using annuities to take advantage of the difference between account value and income value to benefit from tax advantages. The fourth is, let's properly utilize the stretch IRA. And the fifth is, to convert to a lot, and then explore the next steps. Then the sixth is life insurance. I mentioned that various planning options are possible using life insurance. So these methods, by considering each individual's financial situation and goals, by combining and utilizing them, you can reduce the RMD burden. I believe it can increase the efficiency of inheritance. That's all. I hope today's content was helpful. I believe there are many people around you who need this kind of information. This channel is a space for growing together with you. Don't miss out on essential information next time by subscribing and liking. Please help ensure that this information is well conveyed to those around you. Thank you.